All right, everyone. Hey, thanks for joining us at our fourth annual economics seminar with Dr. Robert Eiler. It's been a crazy year. The economy's been up, the economy's been down. Everyone's talking about this big recession that's coming. Is it happening? We'll find out. COVID, I'm sick of COVID. Not going to talk about it. $7 gas, interest rates through the roof, serious supply chain issues. There's a war in Ukraine. Taiwan might be next. So how do we budget and plan for the 2023 and 2024 year with all of this madness? Dr. Eiler is here to help us forecast and understand the current and future economy. After the presentation, we'll do a quick Q&A. I hope the chat's working. If not, we'll probably just open it up to people to be able to talk. All right, I'm going to turn it over to Dr. Eiler and we'll get started. Thank you.
Thanks, Aaron. Can you see my screen?
Yes.
Okay, perfect. So folks, what I'm going to do today is I'm going to try to walk us through a way of seeing where the economy has been, where it is going, and the things you should be thinking about in terms of the trades on both the residential and the non-residential side of those markets. One of the biggest things, as Aaron suggested, is the big R word. And it's been funny because as economists, we normally think about recession with the eyes of having everything happening at once that's bad. And this has been a really wild ride since March 2020 because we forced recession on the economy by turning the economy off. And now in some ways we're feeling the reverberative effects of that turnoff because we're now walking away from a lot of the national level policy supports that we had as a result of making those social choices. So I'll try to weave all the way through that and at the end really try to think about going forward toward 2025, because I think it's more important actually to think about the next few years rather than just next year, even though I know that from a business standpoint, we're really in this sort of 1 year rolling window. I'll talk about that too. But there's some things happening specifically in California that we got to be watching for. And nationally, there may be some effects on California we want to think about. So this is the job situation in the United States, looking at it at the aggregate level and thinking about it from, okay, what is true in terms of the Great Recession, which is our last major recession and its recovery, and where are we at in the current recovery period with respect to jobs growth and getting back to where we were pre-recession. So the blue line is where the Great Recession began at 100, which was November 2007. It took 78 months to get the same number of total workers in the United States back to that number. As of July 2022, we actually have gotten back the jobs that were lost as a result of the pandemic recession and recovery period. So we're now just a little bit above the January 2020 number in terms of total workers in the United States. However, and this is one of the things about recession coming that we have to be thoughtful of. This is why I'm showing you the current recovery. If we look at the lost jobs in the last recession and think about what that means with respect to specific industrial categories, there are still industries that are relatively below or not, relatively largely below where they were January 2020 in terms of jobs and recovery versus what we just saw. Because if you just look at what we just saw, you'd say, hey, look, the economy made it back. We basically recovered. And this is why this slide is important, is because some industries have actually done better in the last year than others, and some other ones still have the COVID shadow effect over them. So these blue columns are where we were immediately after we turned the economy off in 2020, and this is May 2020. So April and May were really tough months on the labor market. If you look to the far right-hand side, industries like accommodation, which is anywhere you stay overnight, food services and drinking, bars, restaurants, and event centers where there's food served, those were really where we saw big losses. And it's kind of hard on this graph to see it, but all those were around 30 to 45% job losses from the January 2020 number. So within 4 or 5 months, a third or almost 40% of some of those industries actually were lost in terms of jobs, which is a major change and historic change. And this is why we were so concerned the first couple months. But by the end of 2020, we had seen recovery across the board. And by the end of 2021, we had seen even more recovery, but the recovery speed had slowed. You can see there's one industry, which is transportation warehousing, which had popped a little bit above the red dotted line, which means that it recovered more quickly. And we knew that. We had more deliveries to our homes. We had more general logistics work and just moving goods around. And what we saw is we saw people who lost jobs in hotels, motels, restaurants, bars, event centers, and to a certain extent in brick and mortar retail move into transportation and warehousing because the demand for jobs were there. Now, as 2022 evolved, which is now May, June, and July in the data, a lot of different industries have now fully recovered or have continued to grow, construction being one of them. So nationally, there were different recovery speeds of the construction industry. That's now nationally about 2% above where we were January 2020. But you can see on the far right-hand side that even though there's a bunch of different industries that have gotten positive numbers as of July 2022, feeding that positive number we just saw, accommodation, hotels and motels and places you stay overnight otherwise, still down almost 20% from the pre-pandemic figure. And these are seasonally adjusted. So we're in the middle of summer in the July data. And after you make all the seasonal adjustments against the January number, which you'd assume would be lower anyway, you're still about 19% down. So that's a lot of workers. In the United States, that's still about 1 million people who lost jobs, who did not get those jobs back yet. Now, that doesn't mean they're not working. It just means that those jobs are not refilled by those employers, which means in some communities, those jobs which used to generate economic activity aren't back yet. And so that's something we're watching very closely. And furthermore, especially if you're part of the construction supply chain with respect to hotels and motels, I've actually seen a lot of activity in Northern California of new hotels. Some of those were in the pipeline before the pandemic. But how much more building is going to take place against demand, which may be somewhat waning as we move into an economic slowdown? But furthermore, will it be based on an employment model that was the same before the pandemic? So we're watching those jobs closely because that can lead to a lot of people who are in long-term unemployment spells. Okay, one of the biggest topics, however, is inflation. So even if you look at the jobs data, and this is why in a minute when I talk about whether or not we're in recession or not, one of the confounding factors is the labor market and its continued strength and continued recovery pace versus inflation, which is a natural deflator of the economy in terms of slowing the economy down. These are the data that the Federal Reserve looks at when it sets interest rates. So the blue line represents this, and the way I try to explain to people is think of that blue line as a way of thinking about the increase in the price of a shopping basket that you buy every month. So all the stuff you buy every month, except for food and energy, that's why that word up there says core. The personal consumption expenditures, what you buy at home, goes into the shopping basket. If we pull out food and energy prices, we get the core things you buy inside that shopping basket. And every month, the price of that basket changes by a certain percent. That's that blue line. And that blue line is looking back 1 year. So that number 4.8 in June, which is the only data point that's called out on this graph, means that in June 2022, the price of goods and services, less food and energy prices that you buy every month at home, went up 4.8% versus the previous June. So that annualized number you can see really shot up after about April 2021, but maybe has peaked in trend. And this is what the Federal Reserve believes it is able to do by increasing interest rates, is turn this specific data point down and try to move it through those red dots. And those red dots are the current forecast for where rates are going. Oh, sorry, where inflation rates are going. And to a certain extent, what the Federal Reserve is trying to do with prices and force it through those red dots, which means we're trying to force inflation to lower points, which makes total sense. Now, a nuance of that process is that those red dots, notice that final red dot that has no date home. The first two dots are 2023 and 2024, but in sort of classic Federal Reserve fashion, that final dot does not have a date, and it's sort of the hand-wavy longer run. And we'll see this come back to us in just a little bit when I show you another graph with some dots. But the point of this graph is that that's the expectation, and to a certain extent, this is exactly what the Federal Reserve thinks it's going to be able to do by increasing rates. Now, for the person on the street, a lot of that really doesn't matter. Are we seeing grocery prices and gas prices actually falling? If you're telling me that everything's falling in price based on increasing interest rates and increasing the cost of credit I face, do I get relief when I go to the grocery store and go to the gas pump? So the optics of those changes are really a big thing. And as we're going to see in a little bit in a bunch of different ways, we're going to look at short-term and longer-term rates against each other and look at so-called yield curve shapes. One of the biggest threats about being this aggressive, as we'll see in a minute, with interest rates trying to fight inflation, is there has to be an opportunity cost of that. The opportunity cost of that is you may see a slowdown in credit provision by banks and credit unions and other lenders because they don't have the rate of return, that difference between the long-term rate at which they lend and the short-term rate at which they borrow or where they gain funding. If that gets closer and closer to each other, a so-called yield curve flattening or inversion, lenders are less willing to lend money, and that could easily slow down progress, not only in residential construction, but in commercial. The next thing, and we'll see some of this later, specifically about California, is housing prices and what's been happening locally with respect to employment. In California, we continue to see employment recover. We're going to see later that some of the same industries we're seeing at the national level still have big problems in California, but California, to a certain extent, has recovered more quickly over the last 12 months than most of the rest of the United States, even though most of the rest of the United States recovered more quickly in the first few months coming out of the pandemic and the social restrictions as they were lifted. But housing prices have been a big deal, and we'll see that later. But we're watching that close as well, because as employment levels move around, will that change the nature of housing prices? And what people want so desperately is, okay, I face higher prices of goods and services, but don't kill my housing prices with these increased interest rates. Unfortunately, a slowdown, if not a downturn in housing prices, is a natural opportunity cost of what the Federal Reserve is trying to do by forcing that blue line through those red dots. One of the biggest things is whether or not it's supply chain or supply side effects in terms of driving inflation versus demand. And it seems like right now, even though there's been a huge amount of debate, if you're reading in those circles, you may or may not be, but if you're reading in those circles about inflation, a lot of people believe it's demand only. And it seems like that's actually been the case for the most part. But I will come back later and talk about a couple things with respect to supply side issues that we have to watch. The first one is looking at the car market. So the reason I show you the car market is because when you see this graph, you're going to see a historic shock in the nature of how cars are delivered to market, and thus what has happened to car prices. So generally speaking, car dealerships and car manufacturers want to have about 2.5 cars on the lot per sale, meaning that they want to have an inventory about 2.5 cars per every one sold. Now, if you look at this, this is monthly data, seasonally adjusted, the ratio of inventory to sales from January 2000 through the end of July 2022. And you can see here that really it kind of weaves depending on interest rates, economic outcomes in terms of whether or not we're in a growth phase or moving toward recession. You can see that that black line has wobbled around, though there has been a couple of episodic points. One is during the Great Recession, which is that middle wide shaded area, there was a real spike in inventory because we just stopped buying cars. And then when interest rates were driven down, we knew we were going into recession, but suddenly the price of cars went down alongside of very strong credit conditions. We started to buy cars again, and we basically eliminated that relatively high inventory and got back on track. But notice again, it's sort of wobbling around 2.5. It goes up for a while and goes below it for a while. Well, when the skinny recession here on the far right-hand side hit, which is the COVID-19 recession in 2020, there's been nothing but a downturn in trend, except for this little hook at the very bottom, which you can see in the shaded area, that maybe we're starting to turn the corner a little bit. But those inventories for car dealerships have gone way down. Part of that's because the supply chains globally have not fully recovered. And by not fully recovering means that we have issues with respect to the innards of cars. And that's a microcosm of general global supply chain conditions. So it is tough to believe that all the inflation is 100% driven by very strong fiscal policy in 2020 and 2021 to try to help people fully recover from having to make the social choice to shut down or lower interest rates. We know some of it has to be supply driven, but why we talked about inflation being relatively transitory and why we expect inflation over the next couple of years to slowly drift down is because we do expect the supply side of our economy to recover more completely globally. There's all kinds of incentives for that to happen. However, as I'll say at the very end, we're watching markets like this very closely, because if we don't see that black line start to creep back up toward its long-term trend, we may have a long-term problem in terms of delivering cars to market, which might tell a story about certain metals, semiconductor chips, and general supply chain efficiencies than we had pre-pandemic that might linger in other supply chains, construction materials being one of them. Our equity markets have been very fickle historically, but when you look at the trend in those markets, this is kind of why I try to explain to people. Those shaded areas, and I apologize for how weird those shaded areas look on this graph, but those shaded areas are the same shaded areas we saw in the last graph, basically the last three recessions. And this blue line represents the raw monthly close of the S&P 500. So economists follow the S&P 500. Don't follow the Dow, don't follow the NASDAQ. We follow the S&P as it's sort of a middle ground, broad-based financial market index. Now you can see in the shaded areas that there was a long, slow downturn in both cases. In the Great Recession, a strong downturn to a small bottom level, which actually was below the level that we saw at the bottom of the so-called dot-com recession, which is that first shaded area to the left. But if you look to the far right, you'll see there was a sharp downturn in the shaded area, which was when we shut the economy off, the markets were selling off like crazy. We knew that was going to happen, but the recovery has been very strong until about 6 months ago. And we started to see markets falter a little bit toward the beginning of this year, and really in February and March, we really saw the beginning of the downslide. The raw data are actually not as important as the 6-month moving average, which is in some ways a way of thinking about the market support over time to come back to where it naturally would be. So the black line is really what we're watching as economists in terms of following the trend. So until that black line actually turns back up, the month-to-month movements that can be very volatile and reflect a lot of fickle aspects of investor confidence or lack thereof, that blue line turning back up may or may not, depending how strong that comeback is, turn that black line back up. But we're watching that very closely. The key is that we should expect that our financial markets are still going to be very volatile for 3 major reasons. Is one, we don't know for sure how aggressive or non-aggressive the Federal Reserve is going to be and how that might change global interest rates in terms of how central banks are looking at trying to fight their own localized inflation. Will inflation linger regardless of what's going on with interest rates, which will undermine business confidence in growth and hiring more workers? And the final shoe to fall in terms of, in a sense, defining that we're actually in recession, and I'll come back to this in just about 5 minutes, is whether or not the labor markets start to have problems. Labor market problems normally mean that businesses are going to see lower demand, and thus you see another sell-off. So how much of the last 10 days in the financial markets are actually a sign that we maybe have bottomed out? There's a lot of chatter, a lot of opinions, but some of it might be that we feel like that the issue with inflation, which was kind of already bet that we were going to see interest rates rise relatively sharply and maybe driving some of that downturn, which is in the shaded area, which hopefully will show up now, that we've seen over the last 6 or 7 months, is now going to slowly come to a close, and financial markets will want to recover. Now, a lot of financial market recovery depends on how we view recession. So let's talk about what the forecast looks like, given all those macro data, and then we're going to start moving in toward interest rates and looking at the construction industry, and then ultimately look at the California economic situation. We are in so-called technical recession because we had 2 quarters of estimated GDP downturn. Now, one of the caveats to that is that the job market has really not reacted. And in fact, if you look at the job market, they remain relatively strong. The second thing is that when you hear that GDP has contracted and that we're in so-called technical recession because those 2 numbers in 2 quarters in a row were negative, you got to remember it's a ratio. So if inflation is relatively high, even if we have relatively high productivity, it can undermine that productivity and create a small negative downturn. And historically speaking, those negative numbers are relatively small. This is why you haven't heard general takes that we're in recession yet, because even though we're in so-called textbook or technical recession, the other parts of the economy in which you would say, okay, this is how we know we're in recession, because the slowdown in real productivity, or let's say the generation of income after inflation, is now led to job loss. So we're watching those things, and when we have a declared recession, those shaded areas we've seen in previous graphs in this presentation, that's because a group called the National Bureau of Economic Research, and their little group that does inflation recession dating for the American economy, doesn't think all the components are actually that we're in a full slowdown yet. And some of it is we're still seeing the shadow effect from the pandemic. However, looking forward, there hasn't really been a full consensus that we are either in recession or going into recession. The IMF, looking globally, has still not declared that we're going to go into recession yet. They have slowed, or they have knocked down their forecast quite a bit, but it's still positive going in toward the end of this year and next year. Most blue chip forecasts, including the Federal Reserve, and when its forecast is it's much slower growth than they predicted 6 months ago, not recession. However, different branches of the Federal Reserve have predicted that we would have this technical recession in Q2 2022, and they were predicting it about 4 months ago. So we've had a real mixed bag out there, and organizations like Fannie Mae believe, in fact, we're going to be slow growth and are actually predicting recession. through the end of 2023, though very, very mild, meaning basically sputtering negative growth between, like, let's say negative 0.5% and maybe positive 0.5% over the next 3 or 4 quarters going in toward the end of 2023. But that is very mild. So there's still a real mixed bag of forecasts out there. But folks, let's just try to think deeply about this in this way. We are in technical recession. If Q3 is positive, we will upset that issue to a certain extent, and we have to watch our labor markets now, because if businesses look at the inflation outlook and think that people are going to stop buying goods and services, they're going to stop hiring. You're also, as I'll show you in a minute, we're about to see a twist in the way that people get unemployment insurance. And when that happens, we might see some people come back on looking for jobs that weren't there previously, which will creep up the unemployment rate, will add to the number of workers out there, slow down wage growth, and we'll see, in a sense, some rebalancing take place in our labor markets, which will not necessarily lead to total recession, but will give a little bit of an impetus to maybe declare, okay, maybe 1 or 2 quarters we're in very mild recession. So the overall message, and I'll repeat this later, is don't freak out about recession yet. The economic situation is still very mixed. And if the interest rates stop rising at the speed they've been over the last 6 months, which they should, and I'll talk about that in just a second, we should at least see credit conditions remain decently available over the next 18 months. But some banks and credit unions and other lenders are going to be a little reticent to lend in certain project areas if they think there's some higher risk, because they're going to want to watch that yield, that difference. And we'll talk more about that in just a minute. But what created this slower growth? And the other reason why we're not necessarily thinking too deeply about a recession yet, or thinking that there's a deep one coming, it might be mild if it's fully declared, but is that it's been a real mixed bag in terms of what's created the slowdown. So the first quarter of 2022, in which we saw this negative 1.6, which is the left-hand side, was really driven by a change in imports. Some other parts of the economy, including a slowdown in government spending, but consumers are still really cranking it out, and residential and non-residential investment was still growing at pretty good pace. So it was really what happened in trade with respect to the dollar's value. Remember, we're talking about 2 quarters ago, not necessarily last week. We saw a downturn there, as consumers bouncing back also means higher imports. However, we started to see some growth in exports. So we got some comeback there. The increase in prices meant we slowed down our imports as well. And the dollar's value internationally was really driven by a little bit more on the export side in the last quarter. And that we should expect that to slow down. But the real kicker and why we went negative in the second quarter is because we started to see a slowdown in investment. Well, no kidding. We saw interest rates really rising with strength. So you should expect investment, and this is exactly how we teach it, is that investment is the first place that when interest rates are rising, especially when central banks are very aggressive, and that starts to move through the yield curve and start to affect longer term rates, it's investment, growth capital that starts to slow down in terms of demand. So notice though that that's kind of a mix, right? 1 quarter is positive, 1 quarter is negative. We need to see investment be negative 2 or 3 quarters in a row, which then should start slow down hiring, which will then start to create full recession conditions. If that does not happen, we might kind of wobble through this negative growth time without having to declare an explicit recession. But if you look back, and this is why you're hearing a lot on the news, there's some items to think about. I don't know why that's doing that. Here we go. Remember, when you hear the number in the newspaper, that growth rate is in fact 1 quarter's growth, meaning in Q2, I'm looking back at Q1 and what happened, and I'm multiplying that number times 4. So if you look back 1 year, meaning if I look back from June 30, 2022 back to June 30, 2021, growth was positive. So that's another belief that we are not really seeing the labor market effects, and thus spending is still continuing to march forward, and that supports the economy even if real productivity after inflation is not growing or is in fact has slipped. And always remember, it's a ratio. So if inflation slows down and productivity sort of trucks along at a pretty decent clip, we will see growth kick back up positive, driven mainly because prices have started to see a little bit of a slide in terms of their growth. We will see. But for right now, if recession comes, and I'll repeat this at the end, if recession comes, it should be mild. It shouldn't last at more than a couple of quarters, but we should not expect continued explosive growth like we saw in 2021. We still are under some of the shadow effects of the pandemic. Okay, well, let's look at construction and start to now move more toward this industry and then what interest rates look like, and then talk about California. If you look from 1994 forward on a monthly basis, this is what non-residential construction looks like. So you can easily see the recessions here. I'm now going to shade those areas because it's important to recognize a couple of things. Non-residential construction is basically everything on the commercial side. You'll notice that there is usually a downturn after the recession is declared on the non-residential side. And some of that's because the pipeline is filling, and then it stops filling once recession is declared and all the elements of recession take place. And then we see a slowdown on the commercial side. I'll come back and talk about commercial at the end with respect to specific sub-industries and ones that might struggle. It's not going to be rocket science, what I'm going to say, but I think it's good to remind people about that. So for the most part, if you look at the non-residential side and you're thinking, wow, I mean, commercial demand for construction hasn't really changed that much in industries you'd expect it to be, that's maybe a good sign that recession has not completely shown up yet, and that should keep things going a little bit, which is good. We need that continued growth to take place on the non-residential side. Residential is where a lot of people are concerned because we're worried about the supply of housing. Same dates, you can see that there were a couple of negative times in between 1994 and 2006, but not a lot to talk about, and then we really got hammered. Residential construction tends to fall before recession takes place, COVID-19 being somewhat of an exception, but you can see on the right-hand side how much growth there has been since the COVID-19 recession took place, and really we should think about the pandemic taking place. What that is now starting to fade a little bit. So if we see this number fading, while non-residential construction is fading but still positive, that could be a sign that the other elements of recession are starting to show their face. And I tend to look at construction and ultimately at investment levels as a real gauge of whether or not we're going into a downturn or not. And those signals remain very mixed. The path of rates, as I talked about before, I'm going to move through this relatively quickly, is something to think about in terms of planning for the future. You should expect rates to remain relatively high, but I say that sort of tongue-in-cheek relative, and I'll show you that in the graph in just a second, over the next couple of years at least. However, one of the reasons why the Federal Reserve has increased rates so aggressively in 2022 is because they knew that the inflation level might lead to an economic slowdown, and the interest rates rising sort of force that slowdown to take place if people are still kind of hedging whether or not inflation is going to linger or not. Increasing interest rates is one way of pushing both businesses and consumers into slowing down their spending. And when they do that, one of the things that happens is that slowdown then creates recession, but then the increase in rates allows the Federal Reserve to lower rates again, kind of like what they did in 2019. You may remember, but it might seem like 1,000 years ago, that in 2016 to 18, we were starting to see interest rates lift up a little bit more aggressively, though it was at a slower pace. After similar conditions at the other side of the global financial crisis as we saw at the beginning of the pandemic. And then we saw 3 rate cuts in 2019 because the supposition is we may go into a mild recession in 2020 had we not done that. And of course, 2020 just turned into total chaos. The Federal Reserve is increasing rates because they want to have some room to move rates down again if necessary as a reaction to that sort of rebalancing I talked about earlier, as the economy starts to see more people come back on to looking for work, back onto the labor force, increasing the unemployment rate, and then by lowering interest rates again, would give the impetus for a little bit more growth and soaking up that surplus labor. So a lot of where rates are going kind of depends on their sort of slowly weaving through this time of fighting inflation. The 10-year Treasury market drives a lot of mortgage or a lot of borrowing activity in terms of construction. So we're watching that closely, but we are still under shadow effects. So if you look at rates and thinking about what that might mean for construction, there are some other sort of non-cost of construction issues with respect to demand and whether or not we actually need the spaces we need, especially on the non-residential side. The residential side is a very wild situation, and I'll talk more about that when I talk about California as a specific submarket in the United States with respect to residential construction in a little bit. But industrial and warehousing demand should remain relatively strong. The demand for restaurant space, brick and mortar retail space, office space, very much up in the air. Almost every commercial real estate professional I talk to thinks that those three industries will see some small rebound, but not a full return to pre-pandemic conditions very soon. And when I talk about different metro markets in California in about 5-7 minutes or so, I'll remind us about what that means when we get there. Okay, this is that other dot graph I showed you. So we think about the path of interest rates over the next few years and think about forecasting and what it means for your budgeting. This is the path the Federal Reserve saw interest rates going from their control, their policy rate in September 2021. All the blue dots for 2022, these blue dots represent the sort of straw poll opinion of policymakers in the United States. So those blue dots sort of tell a story to financial markets. This is where policy rates are going in the US, sort of, with the current data. All those blue dots for 2022 lived in that gray box and were moving along that red line toward 2024. This is where they were in March 2022, and that was the path. So basically more aggressive in 2022, but same basic path as 2024. But the blue dots you see here are June 2022. So way more aggressive in 2022 than predicted even 9 months previous, and still more aggressive toward 2024, but kind of getting back to where we thought we would be. So interest rates are going to be higher. The big bet in financial markets is how much of an increase is enough. And if recession becomes declared overtly, will we start to see interest rates fall? And ultimately, it's about expectations. So no matter all the gobbledygook you hear in the news about what the Federal Reserve is trying to do, or all the debate about how financial markets should read it, it really is about trying to keep inflation expectations the same. So when you look at inflation expectations, and this is why the Federal Reserve has been aggressive at the end of the day, this is the evolution of 2-year looking forward inflation expectations on a 6-month moving average, which is how economists think about it, because it takes some of that sort of episodic aspect of how people are reacting out of the loop. For most of the last 40 years, we have been on this nice downhill slide in the sense that we've taken inflation expectations, really ratcheted them down. Global supply expansion has really fed lower prices globally. Down the slide we've gone, flat as a pancake in the 2010s, but on the far right-hand side, which hopefully you're going to, you'll see just on the other side of that shaded area, that relatively rapid kick up is what the Federal Reserve does not like. So why have rates been going up so aggressively? Is trying to beat that black line back down toward that sort of space between 1% and 2% inflation expectations annually. It's really the goal is to get it around 2%. So as soon as it went above 2, that freaked out a lot of policymakers. If we look at rates historically, this is the 10-year Treasury rate. Notice the far right-hand side, how quickly it's gone up since the pandemic, which is that skinny shaded area on the far right-hand side. So there have been 5 recessions since 1990. No, that's incorrect. This is not, the dates on here are correct, but the shading is not. Far right-hand side is the recession. Notice the real key to this graph, downward slide, except for the last 12 months. This is the policy rate. So the policy rate was jumping all over the place. And then we saw a kick up of the rate toward 2005, down the slide as the financial crisis hit, flat as a pancake, and then has been really rising on the far right-hand side. And there's the 2-year Treasury rate basically following those expectations we just saw. But notice how fast that red line has gone up. And the key, regardless of the shading on this graph, and I apologize for that, the red line meeting that blue line means the yield curve is flattening, which means lenders are less likely to lend. So we need to spread that a little bit, and the Federal Reserve knows that. And the 2-year Treasury, notice how that red line very much follows the shape of the black line versus the blue. So as policymakers make decisions about interest rates, so goes that short-term money, which is the cost of funds for lenders. If that red line gets closer to that blue line and stays close, that's a problem. And you can see that that blue line has been close to that red line at different places, usually right before recession. Okay, that's what's been happening in the last 24 months. How's that going to translate later? Well, something that we've been watching, and I'll talk about this in California in just a second. Here's housing starts, single-family housing starts since 1990. Obviously, this huge boom phase in the 1990s into the middle 2000s, and the hard downturn with the recession, and this slow climb back up, even though the last 24 months has really been a boom in getting more single family homes built. A lot of that's been driven by what we thought would be at least short to medium term demand, and some of that may be starting to fade. This is multifamily. So multifamily really had a renaissance in the 2010s to a certain extent and has continued to see growth here after the pandemic. But if you look at the predicted outcomes in California specifically, this is the national outcome. And why this is important when you think of it nationally is because A, we get data that we believe a little bit better about housing starts at the national level. But what's important about that is that from a California standpoint, is Californians have moved to other places, and as housing starts continue to increase in other states and relieve some of that price pressure, Californians may still have an incentive to move to those other spaces, especially if their jobs remain remote. Here's national wages and jobs in construction. So we think about the data we've seen before. What's happened with construction? Construction, as we know, it recovered more quickly. So notice that black line has been above that red dotted line a longer time than the first slide we saw, but very similar cycle from 2006 forward. Slow, long bull effect downturn, really only just got back to pre-global financial crisis employment in construction right before the pandemic hit, but have already exceeded that number again in the post-pandemic era. Why is that important? It's important because one of the things I'll say at the end is that whether or not we're going to have the workers in construction is one of the biggest things to look for over the next 5 or 6 years, and what that's going to mean for wages, the cost of construction, regardless of the cost of materials and their availability, and what that might mean we have to do with education looking forward in California as a microcosm of the US. Wages have gone up consistently and steadily, regardless of the movement of total employment. So one of the things that's been kind of intriguing about looking at wages in construction industry is wages have just kind of kept on rising regardless of what's been going on. And some of that simply because people have still had a demand to build. Finding workers has been a struggle for some time, especially in the wake of the global financial crisis. But wages, especially after the after the pandemic took place, have been rising steadily and a little bit more exponentially, if you even want to put it that way, over the last few years or over the last few quarters. Now, let's look at California. This is where California is in terms of recovery, not quite back yet. So while the US economy has recovered more quickly than California, California has done a little bit of a better job the last 12 months, but we're still under where we were January 2020 in terms of total employment. So one question I get is whether or not if we have a national recession, will we have a state level recession in California instead? And the answer is probably not. It's unlikely that California would have its own recession versus the national level. But one of the things that's concerning is we still haven't fully recovered yet from the pandemic time. So what's that mean if we see an economic slowdown? How much longer will it take to get back to where we were pre-pandemic? And I'll talk more about that in just a second. Looking at the metro areas around California, this really gives you this sort of tale of two job recoveries. Look at the metro area names or the county names in the upper portion of this graph that have actually seen positive growth. So remember, California as a state has not recovered the jobs it lost. You can see that in that green column where it says negative 0.8. So that's the percentage. We're still down, looking back to right before the pandemic. And you can see the names of the places that are still way down versus pre-pandemic conditions versus the ones that have recovered. The I-5 corridor, some coastal areas of California and some remote areas of Northern California recovered more quickly because they simply did not shut down as completely as other parts of the state. So we're going to debate forever whether or not we should or should not have had such draconian social conditions in certain parts of the state when COVID-19 first started. But one of the things about construction is that if you had a local area that had construction assets and projects in place, and declaring that industry an essential industry allowed growth to continue and likely help support a lot of those areas in the upper part would have positive numbers here in the immediate aftermath of the social shutdown that have allowed it to grow more quickly. So construction has been one of those industries that has really supported the post-COVID recovery in a lot of places. I talked about unemployment insurance claims earlier. This is the roller coaster that we've been on since the beginning of the pandemic. But if you look at these numbers, if you take where we were in January, right before the pandemic is number 100, if you look back, you can easily see the Great Recession in terms of the number of people who suddenly claimed unemployment insurance as a result of job loss, but how long it took to get back to where we were before the recession, the Great Recession took place. It took about 7 or 8 years to get rid of all the unemployment insurance claims because people had lost a job, then other people lost a job, and it was just sort of this rolling window of people losing jobs. In the pandemic situation, we shot up and have been sliding down more quickly, but some of that increase was because we had new programs pop up and a lot more subsidization of losing a job than we'd seen in past recessions. So whether or not we turn this corner or not, in other words, we start to see more people claim unemployment, if they do, and we see people starting to lose jobs in California, it is unlikely we will see broader supports put in like we saw in COVID-19. So we might actually get back onto what we think of as a quote unquote normal cycle. But we're watching unemployment insurance claims again, mainly because it will corroborate the idea of whether or not we're going into recession or not, or support the idea that if it is going to happen, it's going to be relatively mild. So watch that closely. You can see this little hook at the bottom as basically we're getting to the bottom. But remember what I said before. One of the things about the pandemic recession is that there was a lot of fiscal policy that came online to support people who had lost a job. Those supports are going to go away on September 30 in full as the federal fiscal year ends. We will see if that doesn't kick up the number of people suddenly looking for work because they're no longer going to be able to get COVID sustained or a COVID relief package sustained unemployment insurance benefits anymore. I know that's a real mouthful and I've had a hard time getting that out. But that's the idea there in terms of the turn of the corner. Will we see that start to kick up? And if we do, that suggests that we might start to see a little bit more evidence of recession. Wages in California have been rising steadily over the last 7 years. Not as fast as the price of, or the cost of living, but relatively quickly, about 22% increase of all jobs, the median wage of all jobs out there since 2015. Construction has increased in certain trades. So you see carpenters and general laborers have gone up a little faster, at least by the official data. But this is just what's happened since 2019. So if you think about pre-pandemic conditions and what's happened since then, the percentage change in the wages for a lot of the trades have not gone up as fast as other wages have. And that there's two reasons behind that. One is that construction workers tend to have higher wages, so percentage changes in those wages are a little bit harder to get to because you're starting at a higher base. But we've also seen it more difficult to find workers, believe it or not, in other industries in which wages have had to increase a little bit more quickly to try to draw those workers back. And it's in those low wage industries, and that's why that percentage change is so fast. Why am I showing you a percentage change? Is because if we think about inflation, what we're really concerned about when we think about wages is not what you're currently being paid, but what's that current paid by you. So if the percentage change in your wage is not keeping up with the percentage change in the cost of living, notice that in those construction sectors, and the ones I pulled out here as examples, if the cost of living in California is 7%, construction workers overall, or let's say one plucked at random, may or may not be keeping up with that cost of living as much as other parts of the trades are or other jobs are. So the reason why that's important is as time moves on, you might see people moving in and out of different industries trying to seek relatively higher wages as time goes by if they're facing higher cost of living. Well, one of the things that drives higher cost of living, and this is something I wanted to wait to now to say, is that housing is one of the biggest things that sits in that shopping basket every month for people. So housing price growth, and for those of us that are watching real estate prices relatively closely or you're in it directly, whether you're buying, you're a broker and or you are you're in construction of residential properties, it's been crazy. So this is 1 year growth across major areas of California, basically the top 15. And you can see for California, the last 12 months, about 18.5% growth of median home prices. So it was in about June 2020 that we started to see real housing price growth begin, if you look back. And the last 2 years have been an amazing time. And this is the 2 year price growth across these same places, where you can see that in Riverside County, the median home price has gone up about 53% in the last 2 years, based on the latest data, which are June 2022. Now, couple caveats there. One is, obviously, this is a reflection of people changing where they live, some of it being remote work. What we don't know is how permanent these changes are. So for example, in Riverside County in California, or even a place like San Joaquin County, if people moved out there under the supposition that they'd be able to work from home ad infinitum, and then their employer in San Jose says, hey, wait a minute, you need to now come back, or your employer in LA says, hey, you now need to come back to the office, are you now going to be willing to be a commuter long distance? Or are you going to make a job choice in terms of saying, well, I'm not going to be able to do that? We will see over the next couple of years how much more employers really think about the productivity of workers at a remote and sort of disaggregated set of locations versus where people have actually moved under the supposition they may be able to do that for an extremely long period of time. So watching that very closely. We're also watching it nationally. There have been national markets, for example, Arizona and Florida have, and Texas, those three, and sort of politically, ironically, have received a lot of Californians over the last 2 years. Whether or not we see a remigration based on housing prices rising so quickly there that people went there, realized they may not be able to keep their job, and now sell after generating capital gains and come back to California, we'll see. Throughout California, the forecast is still relatively robust, given everything we've talked about, the potential for recession, rising interest rates, inflation still lingering, the cost of construction, especially wages, are still rising. What does that mean in terms of housing forecasts? Well, for right now, most housing forecasts are still relatively positive, have not shown a contraction of prices yet, and there's no talk yet of a so-called speculative bubble in prices. However, that number for California that's now 7% was 15% between April 2022 and April 2023. For June 2022 to June 2023 has almost been cut in half. So I'm expecting you're going to hear housing forecasts talk about flat price growth, if not a little bit negative growth for the year 2023, very, very soon as we creep closer to December 2022. So watch for that. And we should expect that. I mean, let's go back one slide and just really think about this for a minute. If you saw 53% increase in median home prices in Riverside County, should you not expect some flattening of those prices at some point just by the nature of supply and demand? So we have to be, at least in some ways, a little bit more, a little bit less myopic and a little bit more rational. But Riverside County, as you can see, which is number 4 moving left to right, is about 9% growth on top of that 53. That is amazing, amazing median home price growth. Okay. Well, so let's talk about the supply side. As I said before, we saw housing starts, but in California, we don't expect to see an amazing amount of growth in housing units. There's an enormous amount of political wrangling around water, the availability of workers, the cost of construction, housing equity, to build in a way that really provides a complete relief on the supply side. Now, what that should do, at least over the 2020s, is continue to provide support for housing prices at their current levels or something right around it in trend, if nothing else, and most likely more growth. But there are places in California and places you might not even think would have experienced this that have actually seen negative growth of housing units versus growth of housing units, meaning that the building we've done since basically the beginning of the growth phase after the Great Recession has still left some communities in California at a lower level of housing supply. You can see places like Butte County, Lake County, almost Sonoma County, places that experienced a lot of wildfire activity that was focused on residential, well, focused in its damages on housing units, even though we've had fires throughout California and unfortunately having a pretty tough summer again this year. The number of housing units lost in those places I just pointed out were relatively large percentage-wise. So for example, in Butte County and Lake County, the fires of 2018 and 2015 respectively changed about 10 or lost about 10, or I'm sorry, created a loss of about 10% of the housing stock in those two counties. So that leads to a supply shock on top of what we've seen in demand that can lead to some wild price growth. And are you going to rebuild at such a pace that will be relieved? That's the big question. Now you look at the far right-hand side, Placer County, Yolo County, feeding off the growth of the Sacramento metro area, San Benito County, sort of in a sense, feeding off the slow out migration from San Jose. A lot of that we're watching to see if those units continue to climb up, but that's pretty good supply side growth. doesn't mean it's keeping up with demand. And remember, folks, don't make housing markets any more complex. It's supply and demand at the end of the day. It's the components that drive those two, which are the key. So there are supply conditions in housing, similar conditions in commercial real estate that suggest the cost of construction is not going anywhere, but either remaining high or going to continue to rise against already high housing prices, where it's hard to imagine that we're going to see an enormous downturn in housing prices a la 2006 to 8 again. The other thing about that is we don't have borrower balance sheets in terms of their exposure to strategic defaults or creating an enormous amount of existing units going up simultaneously. It should be a much more market-driven rather than panic-driven supply change when existing units start to come up and try to take some of those profits off the table. Now I'm going to give you a couple caveats about California and thinking about the construction market on the labor side. This is the amount of people that were born in California over the last 20 fiscal years, and this is the amount of people that passed on. And the number of people that passed on ticked up a little bit, mainly because of aging, but a little bit because of COVID in the 1 year. This is the number of inbound net foreign residents, meaning that California trades people that are coming in toward California from other countries with people leaving California for other countries. Generally speaking, that's been positive. But people leaving to other parts of the United States in net has consistently been negative, meaning California has lost people to other states. We've actually, the last 2 years, last 2 calendar years and the last 2 fiscal years now, because the last fiscal year just ended, have been negative, meaning that California has actually lost population for the first time in recorded history, and it's been 2 years in a row. That has to hurt demand for all types of construction in the medium term. Now, whether or not it does depends on the type of people that come in and replace them. Now, here's a funny nuance about population growth. So when you hear about population in California, one thing to keep in mind, population is going down, but the number of occupied housing units has actually gone up. So if you're losing population, but you are gaining occupied housing units, it means that you are forming more households with fewer people, which means you're having fewer kids and the people are older. So what that means is that if you start to look forward in terms of the implications on K through 12 attendance, and we're already hearing rumblings of this, if local school districts are probably already complaining about fewer students, the trend in California is to get to about 89% of the pre-pandemic level of kids in K through 12 schools in California by the end of this decade. So if you're down by 10%, what's that mean for construction supply? Where are those workers going to come from? And folks, we're 15 years on now from basically the beginnings of the global financial crisis. Your contractor who was 42 in 2007 is now in his or her high 50s. 10 more years go by and they're out of the market. Where's the new builders going to come from? Where are the new general contractors going to come from? Where are the new planners going to come from? All that's out there. So as we're aging, we're watching closely what that means for schools and what that means ultimately for workforce development. So the bag is mixed for the construction business going forward. It's not all bad. The macro conditions are good, but they're slipping. The geopolitics are crazy. If you look at Ukraine, think about Taiwan, and Aaron kind of alluded to this right off the top. What's that mean for decision making? But further, and this is the key, do we get our supply chains back in such a way that it starts to dampen the cost of construction on the material side, knowing there's going to be still some wage pressure, and will that allow people to actually make the decisions to continue forward with projects? And as we see equity markets sell off, you might in the short term see people converting that to investments in their homes or investment in another home that then would lead to some renovation demand. But at some point that cash will fade, or people will be reticent to let go of that cash versus other uses. So the macro situation suggests that any slowdown means we should expect a little bit slower growth in construction across the board. The labor markets, should we see more workers soon and will hiring slow down? Unfortunately, the answer is yes and yes. We should see more people come on the market, maybe looking for construction work as a job, but hiring is likely to slow down over the next couple of years. Housing markets, there's not a lot of relief in sight, even though it's going to be flatter. Will developers continue to look at new projects? State of California wants more building. Will developers take the bait and build in a market that might see a little bit flatter demand than the last couple of years? A lot of it will depend on how our cities and counties act as partners to get that done, and the politics of doing that locally, for better or for worse. But the cost of construction is unlikely to fall in such a way to suddenly provide cost relief in terms of generating more projects out of the blue. Commercial construction is a very funny market right now. So there's not a lot of places that are sort of, let's say, spec building, especially in retail, in office, in restaurant, or any type of, let's say, sort of flexible retail space in downtowns. Industrial warehousing has been going crazy. That's likely to continue to, but flatten out in terms of growth, because there's a lot of municipalities are very concerned about having too much industrial warehousing and tipping the scales of the types of businesses locally. The key is that think about then the residual effects of that in terms of people not coming back to the office, not coming back as tourists. What's that mean for our urban centers? So commercial construction is a way of thinking about where businesses see things going in such a way that it tells a tale about what other jobs in sort of secondary and tertiary ways are going to be assisted by new commercial construction. A lot of that has slowed down immensely outside of industrial warehousing. We shouldn't expect a big change anytime soon. And probably the biggest thing, once all this stuff clears out from the supply side of the market and we start to see more completely how people are going to go back to work in offices or not, where is the trades going to find its workers, given we know demographic change is coming and the industry is getting older? With a lack of immigration, one of the things that we've tested in the COVID aftermath is how reliant the California economy and especially the trades are on workers that may not be documented. So I know that that's sort of a shadowy thing to talk about in terms of really, we don't talk about that on Friday night with a glass of wine in our hand. But when you think about what really executes these projects, watch that going forward and see how immigration helps or does not help as time goes on. The demographic change suggests we're going to need some labor relief somewhere. So folks, with that, that's what I've got. The next few years look okay, even with recession as a cloudy formation on the horizon. If we go into recession, it should not be like the Great Recession by any means, might be more like the dot-com recession. We've already kind of gone through that equity market sell-off as we speak. So you shouldn't expect that to completely upset demand or upset your business. The big thing is, will lenders be willing to lend? That yield curve inversion is a scary issue in terms of continuing to move forward on projects, and just simply the cost of doing business. If you're a smaller business, where will you find the relief in your market to get around that cost? And if you can't do it, how's that going to threaten your bottom line? Those things are very tough, but if the inflation aspects start to fade a little bit, that should provide some relief. It's going to be a sort of a rocky market for the next 18 months versus the last 18 months. So Aaron, with that, I think I'll stop sharing now. Folks, if we don't get to your questions, please write down that email. This recording will be available, as will the slides, but we can roll the dice here a little bit, and I'll put my video on and see if we want to just take some questions by people who raise their hands.
Well, I think we got the chat working, so
oh, super.
Yeah, if anybody wants to...
Well, you guys are better than me. I don't know how that suddenly started working. That's super.
Yeah, there's a little setting down here that I hit.
Oh, great. Okay.
Yeah. So I don't
any questions, folks? Yeah. Wide open. So we got a question from Donna that asks, what needs to happen in order for supply chains to improve? That's a great question. It is very hard to know, short of maybe two items. One is that we need to be thinking more completely about long-term trade relationships. And some of that is there's an interference pattern with our geopolitics right now. So if you look at what's going on between China and Taiwan, it doesn't look like until that actually simmers down a little bit that the US and China are going to be able to talk about, let's say, more complete long-term trade aspects and knocking down some of those tariffs that were put on during the Trump administration and sort of continued by the Biden administration, and also just thinking about how reliant we are on East Asia. So we've got to see some of that come together, and don't get it twisted. If I was one of the three major shippers that moved goods from East Asia to the West Coast of the United States, and I knew you wanted stuff, and I knew there was only three of us, we're going to monopolize pricing in those markets as long as we can, because we're going to try to make up not only a rising cost of doing business, but lost profits when things really slow down initially. We're going to try to make that up and keep that going as long as we can. So whether or not, and this is part two, whether or not we repatriate some of manufacturing, which is highly unlikely, or try to strike ways of allowing more entrepreneurism in terms of shipping lanes, which is also very tough. It's really about the medium and short and longer term. The short-term relief is really more about getting workers back to work and recognizing the profits are there in East Asia, actually moving those things forward. The medium and long is whether or not we want to be as reliant on those shipping lanes and on other countries to provide an enormous number of goods, or if the US sees itself kind of turning back the clock and providing incentives for manufacturers to come back to the United States and providing a wider setting for supply chains. Construction materials being one of those pieces. The economics of doing that, though, seem very far away. The supply chain issues are partially COVID related, meaning that we know that there's been problems in terms of getting people back to work and keeping them there by the nature of the policies in East Asia. They are also profit related, meaning that if I can dribble out stuff at relatively high prices and kind of keep you wanting more, you're willing to pay more. Willing to pay more with relatively similar or not as quickly rising cost conditions, revenue greater than cost, profit. So it's a combo of the two. And the thing that's nasty is we don't know which one is which any day of the week, because it could be that a bunch of people go back to work in East Asia and we say, okay, so now the reason why it's still a problem has got to be because they're not moving it out as quickly as they could be. There's some inefficiency, whether that is by choice or by design, hard to know. The second is that if you suddenly have COVID spring up, or now monkeypox or God knows what, and those countries from a political standpoint don't want to look like they have any issues, they close everything down and you suddenly have a shortage again. That can play into some industrialist hands in East Asia by having this sort of up and down movement in which you're still in very much command of what goes on. So it's a little bit of a mix. Chris, there's a lot of pressure in the state to get cities to increase their supply of housing, especially by removing regulatory barriers. Will this actually have a big effect on the supply if the yield curve flattening demand and contracting labor market continue to make it harder for developers projects to pencil? Absolutely. Every municipality I talk to, I say, look, you can be as open-armed as you like, and if you're closed, that's going to immediately turn off a developer, but you can be as open-armed as you like. If you still can't make it pencil, they're still not going to build. So you have to be thinking as almost like a site selector, why would I choose your county to build homes? Right? Like, why would I choose to put a commercial space any place? Why would I choose to put my business anywhere? In essence, and I try to explain this when I'm talking to counties and cities, think of a developer as somebody who's making a long-term investment in your community. Why are they choosing your community? And are you a barrier or are you a gate opener for that opportunity? So you're absolutely correct, is that when you add all this up, the regulatory barriers are one issue, but they're not the sole issue in terms of whether or not these projects will pencil for developers, and thus with that sort of multilateral problem, it's hard to know that it's hard to imagine we would build at such a pace that there actually would be some relief to the medium and long-term housing issues in California. That's my take, but I try to really tell elected officials when I get a chance to talk to them, they either need to be the solution or the problem, and they have to pick. Paul asks, when do you think buying an investment property, a vacation home is beneficial in the next year? Let prices slip down about 10% and then buy one. Other than that, what I just gave you was entertainment purposes only advising. It really depends on whether or not you see wanting to hold that property, in my mind, hold that property as a long-term cash flow play. If you buy it in a place that should have rental demand for that vacation property in the medium and long term, and you want the cash to come from it to subsidize the cost of buying the property and ultimately to provide you with cash flow maybe now or later in life. In a place that has relatively strong demand for vacation rentals, I don't think there's actually a bad time to do it. If you're going to use credit right now, especially if the Federal Reserve lowers rates next year, we might see rates slip down in 50, 75 basis points from where they're at right now. So you might want to wait for that. But the other thing to watch for too is buy it in a place that is not currently debating whether or not to put restrictions on the number of vacation homes. If you look for places that are going to potentially put restrictions on the number of vacation homes or monitor and tax homes that are not occupied by principal residents or as the primary residence, that could lead to more costs for you. So be very cautious about where you look, because there may be some things on the horizon that you didn't expect that suddenly tip the penciling over into the wrong direction. Anybody else on the chat now?
But so if somebody's thinking about buying a second property or investment property, you know, there's definitely a relationship between price going down and inflation and interest rates going up. So sometimes I think, oh, maybe it makes sense to buy when the interest rates are high. Eventually they'll come down. Do you think we'll ever see 2% again, or 2.5%, or 2.8?
Great question. So if we go back to the slide in your mind that I showed you when the black line was was all over the place but trending down, but then was flat from basically the end of 2008 to the beginning of 2015, and then was flat again from the middle of 2020 to the beginning of 2021 or 2022. Those are rare historic instances in which the central banks, and generally in those two episodes globally, central banks decided to push the interest rate on overnight money that banks lend to each other down to the lowest possible level available in the marketplace. Now, while it might not seem like that's a rare occurrence, because if you were born in 2008, the 14 and a half years of your life you basically have spent with those kind of interest rates in play, the large preponderance of it has been that way. You might say, well, isn't a 3.5% mortgage not that far away on the horizon? And the answer is it really depends on how the Federal Reserve looks at the use of that zero lower bound in the future. We've had 2 crises recessions in a row. The Federal Reserve knows that this is not the way to shape expectations about what we do during recession. In other words, the next recession, if we declare one, let's say, at the end of 2022, don't expect in 2023 that the Federal Reserve is going to go say, okay, hey, we're in recession again. The last 2 recessions, we drove this policy rate down to 0. Let's just go back there again and kind of see what happens. We're not expecting a crisis in such a way that a central banker would say, based on this unprecedented aspect of what's going on in the economy, we need to take interest rates down to the bottom. That's the reason why we got such great rates, right? But Aaron's point is much bigger philosophically than maybe he even understands. I had students who were 18 years old in 2008. Their adult lives have basically been recession, super low rates, creep up, recession, super low rates, creep up. We're still at historically low rates. Will somebody who's now 35, who was 18 or 19 when the global financial crisis started, ever accept a mortgage of 6%? That's something to think about, not only from a housing demand standpoint, but also from a commercial demand standpoint, as those 35-year-olds become business owners, potential lessees, potential buyers of property. Will they look at real estate and the use of credit at those rates and say, hey, I'm gonna sit on the cash? So it's something to think about.
Interesting. And one more question about that is, if there's a Democrat or Republican in the White House, that has a big effect on where interest rates are going to go, doesn't it?
It really shouldn't, but it can, depending on what fiscal packages come out of the White House and how that generates change in Congress, and how what Congress wants to do with spending means how they want to sell debt. And then is the Federal Reserve kind of on the hook to purchase that debt? And if it does, and when it buys that debt, it beats down the rates. So whoever's in the office, whether it be Democrat, Republican, or God knows what's going to come out of everything in the end, it'll depend on the fiscal package that comes out. So it should not be a direct link, meaning that I should be able to pick up the red phone and say, hey, lower rates today. That's not how it works in our economy historically. And generally speaking, we've kept that going, even though, behind the scenes, again, on Friday night with a glass of wine, you're going to say, oh, it's all rigged and these guys are all talking to each other. They're certainly talking to each other, but the link is more indirect in that they need to have the bonds purchased right away. The biggest pot of money is with the central bank. They print the money, they buy the bonds, it beats down the rate, does everything the Federal Reserve wants to do and as the government wants to do too. Then the bonds get sold to the greater markets. And in a sense, you get the spending and the lower rates initially. The more and more the government spends, though, the harder and harder the financial markets are pressed to buy all that debt at relatively high bond prices and thus low yields. So that's another thing to watch. Another reason why we've seen 10-year treasuries creep up is because those bonds are all starting to come on market now, right? The Federal Reserve has done what's called quantitative tightening. So it's taking those bonds that initially purchased and now pushing them onto the market. When they do that, they have to lower the price of those bonds, and that kicks up yields. So that's something else to watch in terms of how those fiscal packages, we pay for them either now or later. We definitely pay for them one way or the other. We got another question from Alicia that says, isn't the U.S. long-term looking at like a Japan-like stagnation in interest rates? The answer is, to a certain extent, yes. And you can even make the case that the last 15 years have been a somewhat policy-driven reflection of that. We are going to age. Our birth rates are down. Our saving rates have actually kicked up a little bit. The global financial crisis kind of created more of that. The difference with our economy and the Japanese economy is we tend to be more dynamic in terms of immigration and the nature of how our birth rates have moved up and down. So even at lower birth rates, we're still higher than Japan, but we should expect similar slower growth and lower interest rates if we become much more of a country of savers than consumers, and that's because our profile will age. So yes, you should expect Japanese-like economic conditions, but not a complete symmetry in the Japanese and the American experiences.
All right. Any other questions, guys? All right, I guess we'll up. But then towards.
So trend to lower rates. Yeah, you should expect rates to remain relatively low, historically speaking. Thanks, folks. Thanks, Aaron.
All right, thanks, everybody. We will see you next year. Robert, thanks again. We really appreciate your time and your wisdom.
Thanks.
It's
Thanks
nice to have somebody kind of put it into perspective so we can go into the next year or two thinking like, wow, like the world's not coming to an end and business may actually be okay for the next few years. So
yep.